The Gold Reserve Act of 1934, often at the center of discussions regarding government control over precious metals, has a significant role in the history of the United States, particularly during times of economic uncertainty. While this law specifically focused on gold, its principles are integral in understanding the potential for the U.S. government to take similar action with silver, particularly in the event of another national economic crisis. To grasp the full extent of how the 1934 law works and how it might be activated again, it's essential to begin by examining the situation that led to its creation. The year 1934, amidst the turmoil of the Great Depression, was a time when the United States was facing unprecedented financial instability. The economy was in freefall, millions were unemployed, and banks across the country were failing. People's savings were wiped out, and there was widespread panic. The government needed to take drastic measures to restore confidence in the financial system and stabilize the economy. At the heart of President Franklin D. Roosevelt's response to the crisis was the idea of reducing the public's access to gold. This wasn't just an arbitrary decision. Gold, as a precious metal, was the backbone of the U.S. monetary system at the time. The dollar was directly tied to gold, meaning that every dollar in circulation had to be backed by a certain amount of gold in the nation's reserves. During the Great Depression, gold hoarding became a problem. Citizens, unsure of the future and fearful of the economic collapse, started to withdraw their gold from the banks and hold it privately. This action further decreased the amount of gold available to the federal government, putting even more strain on the financial system. The U.S. government, in an effort to boost the economy and stabilize the dollar, took an unprecedented step. It effectively nationalized gold. In 1933, Roosevelt issued an executive order requiring citizens to turn in their gold to the government in exchange for paper money. Those who didn't comply faced heavy fines and imprisonment. This was the first significant step in what would later become the Gold Reserve Act of 1934. The law, passed with the intention of preventing further gold hoarding, allowed the government to control and manage the gold supply, essentially removing gold from circulation in private hands and putting it into government storage. This move was part of a broader effort to restore faith in the financial system, and it was deemed necessary for the U.S. to regain control over its monetary policy. While the law focused on gold, it also set a legal precedent for the government to take similar action with other precious metals, including silver. At the time, silver, like gold, was an integral part of the U.S. monetary system, used in coins and as a store of value. Understanding this historical precedent helps us understand why and how a future president might invoke the 1934 law, or laws derived from it, to take control of silver, especially during a national emergency. In 1934, the U.S. economy was in a dire state, and the government had to take measures that might have seemed extreme at the time. Yet, these actions were justified by the belief that only through the government's control over gold could it restore confidence in the dollar and stabilize the country's financial standing. By nationalizing gold, Roosevelt was able to increase the money supply, which in turn allowed for more credit and borrowing, effectively pumping life back into a stagnating economy. But the law didn't just affect gold, it opened the door for future government action regarding precious metals. As the years went by, the use of silver in currencies slowly dwindled, and the U.S. eventually stopped using silver in its coins. However, silver retained its value as a commodity and a hedge against inflation. The history of government control over gold is vital to understanding how similar actions might be applied to silver in the modern era. The world of finance has evolved since the 1930s, and the U.S. dollar is no longer directly tied to gold. The Bretton Woods system, established after World War II, replaced the gold standard with a system where the dollar became the world's primary reserve currency. But silver, despite no longer being used in coins, remains crucial to the global economy. It is used in a wide array of industries, from electronics to solar power, and it continues to be a valuable commodity. Looking at the present-day financial system, we can draw parallels between the conditions that led to the creation of the 1934 law and the potential economic challenges the U.S. may face in the future. The debt crisis is one of the primary concerns that many economists point to as a key reason why the U.S. government might find itself in a similar situation to that of the 1930s. The national debt has reached unprecedented levels, and inflation continues to rise. These financial pressures could create conditions that make the control of precious metals, including silver, an attractive option for the government. Additionally, with the growing interest in silver as a store of value, particularly among investors looking to hedge against inflation or economic instability, the demand for silver has been increasing. In this context, the U.S. government might consider seizing silver to control its price and prevent it from being used in ways that could destabilize the financial system. The government's ability to take action in times of national emergency, using laws like the Gold Reserve Act of 1934 as a legal framework, would provide the necessary authority for such a drastic move. Understanding the legal underpinnings of the 1934 law is key to recognizing its relevance in today's world. While it was enacted during a very different economic climate, the principles behind the law remain applicable in the context of modern financial crises. The U.S. government's ability to act in times of economic emergency, particularly when it comes to controlling precious metals, remains an important tool in its economic arsenal. The 1934 law, though focused on gold, laid the groundwork for government intervention in markets for valuable commodities like silver. To summarize, the 1934 law was a direct response to the economic challenges of the Great Depression. It was designed to prevent the hoarding of gold and stabilize the U.S. economy by allowing the government to control gold reserves. This law, while primarily focused on gold, set a precedent for government action on precious metals, including silver. Understanding this historical context is crucial in evaluating the potential for the U.S. government to seize silver in the future. If the U.S. faces a financial crisis of similar magnitude to the Great Depression, the government may once again turn to the legal powers established in 1934 to control precious metals, including silver. In this section, we delve into the idea of President Donald Trump, or a future U.S. president, using the legal framework established by the Gold Reserve Act of 1934 to seize silver. At first glance, this might seem like a far-reaching possibility, but when viewed in light of the U.S. financial challenges and historical precedents, it becomes clear that invoking this law to seize silver could be a strategic and practical move in certain economic scenarios. To understand how such an action could unfold, we must first consider the state of the U.S. economy. The U.S. has faced numerous economic challenges in the 21st century, with growing national debt, the impact of global trade imbalances, and inflation. These economic stressors are amplified by the rising value of precious metals, particularly silver, which has historically been seen as a hedge against inflation. As inflationary pressures rise, silver could once again become an attractive asset for individuals and investors looking to safeguard their wealth. This would increase the potential for silver hoarding, creating an environment where government intervention might be necessary to control the commodity. For President Trump, invoking the powers of the 1934 law could align with his economic policies, which have often focused on securing U.S. financial interests, renegotiating trade deals, and safeguarding American assets. His economic approach has frequently been unconventional, and his willingness to take bold actions could make the activation of such a law a real possibility, particularly in times of national crisis. One of the most significant issues that could lead to the use of the 1934 law in the near future is the U.S. national debt. As of now, the U.S. faces a staggering national debt, which continues to rise at an alarming rate. The U.S. debt is over $30 trillion, and as the debt grows, so does the pressure on the country's financial system. A national debt of this magnitude has long-term implications for the stability of the U.S. dollar and the country's overall economic security. Inflation is also an increasing concern. Over the past few years, inflation has been steadily rising, pushing up the cost of living and eroding the purchasing power of the dollar. The value of the U.S. dollar is intrinsically linked to the government's ability to manage its monetary policy, and as inflation increases, the dollar weakens. In these circumstances, silver, as a tangible and historically valuable asset, could become even more important. Individuals and institutions may turn to silver as a store of value, much like they did during the 1930s when the Gold Reserve Act was passed in response to gold hoarding. In such a climate, if silver prices rise dramatically, it could lead to a situation where private individuals or foreign governments control a significant portion of the precious metal. The government might see this as a threat to its ability to maintain financial control. The seizure of silver could then be viewed as a necessary move to stabilize the economy, similar to the nationalization of gold in 1934. By controlling silver, the government could ensure that the asset remains available for economic use and prevent private individuals from hoarding it, which could further destabilize the economy. Silver has always been seen as a store of value. Throughout history, people have turned to silver in times of economic uncertainty. And in the 21st century, silver has once again become a popular hedge against inflation and economic instability. If the U.S. economy faces a downturn, especially with rising debt and inflation, silver could experience a surge in demand. Investors and individuals may flock to silver as a way to protect their wealth from the volatility of fiat currencies like the U.S. dollar. For example, during the 2008 financial crisis, many investors turned to gold and silver as safe haven assets. With fears of an impending recession or financial collapse, people sought to protect their wealth by holding on to precious metals. If a similar crisis were to occur in 2026, the demand for silver could rise substantially, driving up its price. In such a scenario, the government might view this as a threat to economic stability and take steps to prevent private individuals and entities from accumulating too much silver. Trump, with his focus on securing American assets and protecting the nation's interests, might see such a move as necessary to safeguard the financial system. The 1934 law provides a clear legal path for the government to take control of silver, just as it once took control of gold. By invoking this law, the government could prevent a situation where private hoarding of silver undermines the value of the U.S. dollar, ensuring that silver remains available for industrial use and as part of the nation's financial system. Another factor that could influence the U.S. government's decision to seize silver is the shifting dynamics of the global economy. In recent years, the world has seen increasing geopolitical tensions, particularly between the U.S. and nations like China and Russia. These tensions, coupled with trade wars, have created an atmosphere of uncertainty in the global financial system. If global markets become more volatile, or if the U.S. faces significant trade imbalances, silver could once again become an essential asset for securing economic stability. In such a scenario, the U.S. government might decide that taking control of silver is necessary to protect the country's economic interests. As a key industrial metal, silver plays an important role in numerous sectors, including technology, electronics, and renewable energy. If the U.S. finds itself in a conflict with a nation that controls a significant portion of global silver supplies, it could be in the country's best interest to ensure that silver remains in domestic hands. A seizure of silver could prevent foreign nations from stockpiling the metal and potentially using it as leverage in economic negotiations. Furthermore, if the U.S. dollar loses its status as the world's primary reserve currency, silver could be used as an alternative store of value. In this case, the government may act to control the metal to ensure that the country remains financially secure. The activation of the 1934 law would provide the government with the legal tools it needs to take control of silver, much like it did with gold during the 1930s. Throughout his time as president, Donald Trump demonstrated a willingness to make bold, unconventional decisions in pursuit of what he believed were the nation's best interests. His policies on trade, taxes, and the economy were often at odds with traditional approaches, and he was not afraid to take actions that might have been seen as controversial. His administration's economic policies were designed to prioritize American interests, from renegotiating trade deals to implementing tariffs on foreign goods. Given this track record, it is not out of the realm of possibility that President Trump, or a future president with similar priorities, could use the 1934 law to seize silver in times of economic distress. The legal framework is already in place, and the nationalization of precious metals, particularly silver, could align with Trump's broader economic goals of securing U.S. assets and protecting American wealth. Trump's approach to the economy was rooted in the belief that the U.S. needed to act decisively and assertively in the face of global challenges. As the U.S. grapples with rising debt, inflation, and geopolitical tensions, the possibility of invoking the 1934 law to seize silver may become more realistic. If silver becomes an increasingly valuable asset, the government might take steps to ensure that it remains within its control to avoid destabilizing the financial system. In conclusion, the potential for President Trump or a future U.S. president to use the 1934 law to seize silver in 2026 is not as far-fetched as it may seem. The economic conditions of the present, including rising debt, inflation, and the increasing value of silver, make such a scenario plausible. By understanding the historical context of the 1934 law and considering the broader economic landscape, it becomes clear that the government could invoke this law to take control of silver in times of national crisis. Whether to stabilize the economy, prevent hoarding, or protect U.S. financial interests, the 1934 law offers a legal avenue for such an action to be taken. If President Trump, or any future U.S. president, were to invoke the 1934 law to seize silver in 2026, the consequences would be far-reaching, affecting not only the precious metals market but also the broader economy, individual wealth, and public sentiment. The government's decision to seize silver would undoubtedly stir up significant controversy, and the implications of such an action would be felt across a variety of sectors. In this section, we will explore the potential consequences of such a move, both from an economic and social perspective, as well as how the public might react to this dramatic step. The immediate economic consequences of a silver seizure would be profound. First and foremost, such an action would create shockwaves in the precious metals market. Silver, like gold, is widely traded on global commodity markets, and a government-imposed seizure would disrupt these markets. Investors and traders who hold large amounts of silver would find their assets effectively confiscated by the government. While the government might compensate them in some form, the forced sale of silver would likely drive down the price of the metal in the short term, as the sudden influx of silver onto the market could create a glut. On the other hand, the long-term effects on silver prices would depend largely on how the government chose to handle the seized silver. If the government chose to retain the silver in its reserves, it could potentially stabilize the metal's value, reducing volatility in the market. However, if the government chose to release the silver back into the market over time, it could create a steady supply of the metal, potentially keeping prices lower than they would be in a situation where silver remained a limited privately held commodity. In addition to affecting silver prices, a government seizure of silver would likely have broader economic implications for other sectors that rely on silver. For example, silver is a key component in various industries, including electronics, solar energy, and medical devices. A disruption in the supply of silver could lead to shortages in these industries, causing prices to rise for products that depend on silver. This could, in turn, lead to higher costs for consumers and businesses alike, adding to the economic strain that the country is already facing. Another potential consequence would be the erosion of trust in the financial system. Precious metals like silver are often seen as a hedge against inflation and a store of value in uncertain times. If the government were to seize silver, many individuals might feel that their wealth has been unjustly taken, especially if they were forced to turn over their silver holdings under threat of legal penalty. This could lead to a decline in consumer confidence, as people may fear that other assets could also be seized in the future. This loss of confidence could further destabilize the economy, making it harder for the government to implement policies designed to restore stability. The most direct impact of a silver seizure would be on individuals who own silver as an investment or a store of value. For many Americans, silver represents financial security. It has long been seen as a way to protect wealth from the erosive effects of inflation and economic instability. A government seizure of silver would directly threaten the financial well-being of individuals who have placed their trust in this precious metal. In the short term, those who own silver would likely be required to surrender their holdings to the government, either through a buyback program or a compulsory exchange for US dollars or government bonds. While the government might offer compensation, the amount paid would likely not fully reflect the market value of the silver at the time of seizure. This could leave many individuals feeling that they have lost not only their wealth but also their right to private property. The loss of private property rights would be a central point of contention in any silver seizure. One of the foundational principles of the U.S. Constitution is the protection of private property, and a government action that violates this principle would likely spark significant legal challenges. Critics of the seizure would argue that the government's actions are an infringement on the rights of individuals and businesses. Legal battles could drag on for years, with plaintiffs seeking compensation or the reversal of the seizure. This would add further uncertainty to the financial landscape, potentially leading to a prolonged period of instability. Beyond the immediate impact on individuals, a silver seizure could have broader consequences for people's trust in the financial system. If the government were able to seize a significant portion of silver from private hands, it could set a dangerous precedent for future actions. People might begin to fear that other assets, such as real estate, stocks, or even cash, could be taken by the government if the economic situation deteriorates further. This fear could lead to a rush to move wealth out of traditional financial systems, potentially sparking a flight of capital from the U.S. economy. A silver seizure would undoubtedly spark strong reactions from the public. The concept of the government taking private property is one that has historically been met with resistance in the United States, especially when it involves valuable assets like silver. Protests and public demonstrations would likely occur in response to the seizure, with individuals and advocacy groups arguing that the government is overstepping its bounds. Given the current political climate, where divisions over government authority and personal freedom are already pronounced, such an action could fuel widespread outrage. Many Americans would view the seizure as an unjust infringement on their personal rights, particularly those who hold silver as part of their retirement savings or as a hedge against future economic instability. This sense of injustice could lead to protests and possibly civil disobedience, in which people refuse to comply with the government's orders to turn in their silver. The government would have to decide whether to use force to enforce the seizure or whether it would opt for a more peaceful resolution. Either way, the potential for widespread unrest would be high. In addition to public protests, the political fallout from a silver seizure could be significant. Politicians, particularly those in opposition to the president, would seize on the controversy as a way to rally their base and criticize the government's overreach. Legal challenges to the seizure could also be mounted, potentially leading to a protracted legal battle that pits individual rights against the government's need to control the economy. The political ramifications of such a move would likely extend well beyond the immediate issue of silver, affecting the president's broader agenda and future policy decisions. Beyond the economic and political implications, a silver seizure could have lasting social and cultural consequences. Silver has long been viewed as a symbol of financial independence, and the act of the government taking control of this metal could be seen as a violation of personal freedom. For many people, silver represents a way to safeguard their future and protect themselves from the uncertainties of the global economy. The seizure of silver could erode this sense of security, leading to a broader societal shift in attitudes toward government control and individual rights. In a society where personal freedom and autonomy are highly valued, the idea of the government seizing valuable assets would likely lead to a re-evaluation of the relationship between the state and the individual. People may begin to question the role of government in their financial lives and whether their wealth is truly safe under the current system. This could lead to a broader movement advocating for greater personal freedoms and less government intervention in people's financial affairs. The seizure of silver might also create divisions within society. While some may view the government's actions as necessary to stabilize the economy, others would see it as an unacceptable violation of their rights. These divisions could further polarize an already divided nation, leading to increased tension and conflict between different political and social groups. In conclusion, the consequences of a silver seizure would be far-reaching and multifaceted. Economically, it could disrupt the precious metals market, destabilize industries reliant on silver, and lead to inflationary pressures on consumer goods. Socially, it would spark widespread protests, legal challenges, and a re-evaluation of the government's role in the economy. Politically, it would have significant repercussions, with intense debate about the balance between government authority and individual rights. Ultimately, a silver seizure would be a highly controversial and divisive move, one that would test the limits of government power and provoke strong reactions from across the political spectrum. While the 1934 law provides the legal framework for such an action, its use would come with significant risks and consequences. The future of silver in the U.S. economy and the government's role in controlling it would depend on how the public and the political system respond to such a drastic measure. The fallout from such an action could shape U.S. policy for years to come, leaving a lasting impact on the nation's financial and political landscape.